But they say there's two sets of tax laws in this country. It's an old saying I heard a lot years ago. I don't remember who said it. But there's two sets of tax laws in this country, one for the informed and one for the uninformed, right? And I think more and more we learn, the more that's true. So I'm going to switch gears completely. I'm going to talk a little bit about income taxes. And I'm going to talk about a product called private placement life insurance. So in order to understand this, you kind of have to do a reboot of everything you ever knew about life insurance when you bought life insurance from a life insurance company off the shelf. Okay? This is not life insurance off the shelf. This is private placement life insurance. And what it is, it's a life insurance product, has no big front-end loads, doesn't pay big commissions, but it basically allows you to invest money the way you're investing it now, in the absence of real estate, let's say. But if you're liquid investment stocks, bonds, master limited partnerships, hedge funds, whatever you're buying now in terms of those types of assets, it allows you to invest the way you're investing now, but do it in a tax-free environment, sort of like an IRA. So why is that so important to save taxes on your investment portfolio? Not to beat a dead horse, but if you pull out a sheet that looks like this, says SEI on it, and the purpose of this is not to be an advertisement for SEI, which is an investment management company, but they have a very interesting study in here on page 2 of this. Turn to the page where you see a graph at the bottom. Okay? And this is just someone who invested 60% in stocks, in index stocks, okay, the Russell 3000, and 40% in bonds using Barclays bond index, okay? And what this little graph says, that if you put $100,000 into this investment back in 1979, should be on page 2 of that, Larry, you see it at the bottom? $100,000 in 79, by 2016, it would have grown to $4,344,000 before tax. But if you pay taxes on that portfolio every year, if you just, whatever the taxes were on the Russell 3000 and Barclays bond index, you would have lost $2.6 million out of the $4.3 million to taxes between 1979 and 2016. You would have had $1.7 million left after taxes. So saving income taxes, pretty important thing, okay, because you'll wind up with more money. The other reason I think saving income taxes is really important is you invest differently. You can invest differently in an IRA than you do outside of an IRA, right? Because right now, most investment advisors are saying that you're better off overweighting your portfolio, for example, to Europe and Japan than you are in the United States, right? There are better opportunities in Europe and Japan right now than there are in the United States based on the PE ratios. Stocks are cheaper there. Well, we have a lot of clients who have money they invested a long time ago in domestic stocks. We're not just going to sell those and move the money into Japan and Europe. Why? Yeah, I'm going to pay capital gains tax on them and spend a lot of time just getting back to even, right? So the other thing that happens in an IRA or a tax-free environment is you can take advantage of opportunities that you wouldn't be able to take advantage of because you don't have to worry about taxes. And the third thing is that in order for you to use your money, if you have appreciated assets, appreciated stocks and bonds and an appreciated portfolio, in order for you to spend it, you have to convert it to cash, right? Because Publix doesn't take stocks and bonds last time I checked, right? You have to convert it to cash. So when you convert it to cash, you have to pay tax on it. Private placement life insurance enables you to invest similar to the way you're investing it now. Money accumulates without cash. You can trade, you can do whatever inside of that portfolio. You can go from Europe to Japan to the United States. When you take the money out of the life insurance policy, you get to take your basis out first as a withdrawal. And if you want to take more than your basis out, it comes out in the form of a loan, and they charge you 25 basis points. Now, I don't know if you've ever compounded interest on 25 basis points, but I did, just to check it out. And I can tell you, relative to the size of the portfolio, it's very, very small, even if it compounds out. So you not only get to invest tax-free and accumulate tax-free, the money actually comes out tax-free, which is, last time I checked, better than an IRA, right? Except a Roth IRA. Well, it's like a Roth IRA. You have some information in your portfolio from Lombard, who's the largest private placement company in the world. It's one of the companies that we use. Daniel Davies is in the back. He's a representative of Lombard, just to make sure I don't say anything that's not true. Or if I need support. But there's some really good information inside. They have, Lombard, by the way, is owned by Blackstone. Blackstone bought Lombard. And Blackstone's the biggest asset manager in the world right now. Lombard happens to be the biggest, I think, private placement, right? In the world, is that right, in the country right now? 80 billion of assets inside of it. There are no commissions on this product. This is really an investment type product. It enables you to invest money tax-free. They have over 200 mutual funds in here from American funds, BlackRock, Dimensional funds, Fidelity's in here, Vanguard's in here, Dreyfus is in here, John Hancock, J.P. Morgan, Legg Mason, Lord Abbott, MF. There's over 200 different funds, and they also have a whole bunch of specialty funds, which I have here. Oh, here it is, which are basically hedge funds and master limited partnerships and a number of specialty assets. What else is in there, Dan? Alternative investment types. Most of what you can buy outside, you can buy inside of this product. I was invited to a seminar in New York City a couple years ago by a guy named Russ Allen Prince. I don't know if you've ever heard of him, but he's written about 30 books on advising the ultra high net worth. Been doing this for a long time. The seminar was held at a law firm called Withers and Bergman, which is on Park Avenue in New York. Law firm that basically caters to the ultra high net worth. And one of the attorneys that was speaking, and there were 3 or 4 attorneys that spoke that day. I was on one of only 25 people invited to this thing. And fascinating, by the way, on health. The ultra high net worth, by the way, are interested in 3 things. One is personal security, kidnapping and blackmail, things like that. The second big thing is health, and the third big thing is taxes. So one of the things they said at this seminar was that they recommend, Withers and Bergman recommends private placement life insurance to all of their ultra high net worth and family offices. Okay. The costs are, well, Dan, do you want to talk a little bit about the costs inside the product?
Yeah, so in the private placement life insurance, the costs are essentially basis points on the assets in the account. Mm-hmm. And if it's private placement life insurance, to be life insurance, to get the protection under the IRS code, which for us we refer to as 7702.
Right.
You have to charge a cost of insurance on the product.
Right. There's a minimum amount of life insurance you have to have in order to be qualified as a life insurance product and get all the benefits of life insurance. So you pay the mortality expense of the life insurance.
Did you put it on a 2-year-old grandchild?
If you can justify the amount of insurance based on net worth you've transferred to them already, John, certain times, yes. You can put it on your children because they're going to have lower mortality costs than you, and you can be the owner, right? And one of the reasons I brought this up is this concept of a mixing bowl partnership that Marvin referred to is kind of a neat way to be able to get your assets from where they are now in a taxable environment into possibly a tax-free environment without paying the capital gains tax on your current assets. Like Marvin said, I'm not going to go into all the mechanics of that because there are mechanics to that, but it is possible to do that. And I will tell you, this product, this is really, there are several, there are, how many companies are in this market now? Maybe 10?
Yeah, under 10.
Under 10. But it's become a huge, it's becoming a huge market. I really started looking at it when that law firm said they recommended to 100% of their clients. And I've learned a lot, I got to tell you. So, yeah.
If you've moved your assets to one of these trusts that Marvin was talking about,
Mm-hmm.
and you have stocks and bonds, how does this investment play
Well, the neat thing,
inside of the trust?
well, it's perfect inside of a trust because, number one, you won't pay tax on the growth. Remember, in the trust that Marvin's talking about, who's the taxpayer? You are.
You are, yeah.
All of a sudden, you're not paying tax. You're taking money out tax-free.
Okay, so this product sits in the trust.
Right. Trust is the owner.
And
You're the,
residents earn income
exactly.
shelter.
Just like they're doing now outside
And then
the
when
policy.
when you die, the proceeds go
Right.
into that trust, and they're not subject to estate tax.
Right, and what's neat
So it's
is
the best
when-
of all worlds.
That's best of all worlds. And in fact, the loans, if you've been borrowing money out at 25 basis points, when you die, the death benefit pays off the loan. Tax-free. Right? So you never do pay tax on the growth on your investments. That results in a lot more money. And I got to tell you, the costs inside these policies are way less than the taxes you're paying. Yeah.
So these assets are basically locked up in the product from the time you start it until you die.
Mm-hmm.
The value.
Mm-hmm. Right.
You can change the asset,
Yeah, you can change
buy and
amongst.
sell and whatever.
Yeah.
But that principal amount
Mm-hmm.
is locked up inside the product.
Well, unless you cash it in and pay the tax. You can always cash it in.
Cash it in.
Well, you can borrow. You borrow out. You can get to the money, David. You know, first of all, if I have $5 million in there and I want $1 million, I'll just borrow it out
You borrow.
at 25 basis points. I won't have to pay any tax. Right? So it's and the other thing that I was going to bring up that I think is interesting is what happens to your trusts that you've set up that Marvin was talking about after you die? Who's the taxpayer now?
The heirs.
The heirs, or who else? Or the trust.
The trust is, yeah.
So if whatever money you leave in the trust, if the trust earns money and you don't pay it out, that trust has an exemption of about a little over $12,000, above which you go immediately to the highest tax bracket, which is 37%. Immediately to the highest, over $12,000. So now, having the money in a vehicle like this, unbelievable benefit. And by the way, the other thing I didn't mention is this product, if you own it, it's creditor proof in Florida. Cannot be attached by creditors or predators. Yeah, right. Okay. So I think it's something to consider. You have some information in your packet. There's a lot more information than this, but so if you're interested, obviously we're more than happy to talk to you about it.
Yeah, just to kind of piggyback on that, a couple more thoughts about PP. We a lot of times call this PPLI, private
Right.
placement life insurance, and I have in my career prepared tax returns, and CPAs are going to tell you this. There's nothing worse than getting a K-1 from a hedge fund.
That's true.
Nothing. If you get it, you get it on October 14th.
Oh, by
Yeah,
the way,
yeah.
actually you brought up a good point, Marvin, because with
Months after you need it.
with this product, no more K-1s.
No more.
No more
That's
W-2s.
my point.
Nothing. Your tax
Yeah.
return gets very simple.
I, as a tax preparer, can tell you that that's by
Right?
itself.
Yeah. Oh, I
enough
forgot.
reason.
That's right.
No,
No more-
no K1. You don't have to do all those schedules.
No more 1099s, no more K1s.
Yeah, your CPA may not tell you about that actually, but,
That's right.
but and you also asked about the cost, and I tell you, in weighing the cost of this, you have to also weigh the fact that you're not paying income tax.
Right.
So it's the cost is X, but it's minus the income tax savings, and my experience with this is that the income tax savings far outweigh the cost. So look at the numbers, but generally speaking, the fact that you avoid income tax, it more than offsets, way more than offsets the cost of doing this.